In this video, we are going to talk about monthly dividend stocks. So before starting, please like this video and subscribe to this channel for our future updates. Month-to-month dividend stocks allow investors to generate monthly passive income from their investments. As a result, dividend income can be used to offset the expenses incurred by an investor. As a result, monthly dividend stocks are perfect for retirees and other investors who rely on a steady income. With an eye on the monthly payouts, of course. Here are some monthly dividend stocks. So let's start. Number 7. Agree Realty. Due to the fact that they provide recurrent rental income, real estate investment trusts, REITs, such as Agree Realty are excellent monthly income stocks to invest in. The company owns freestanding retail properties that are leased on a triple net basis, which means that the tenants are responsible for all of the costs of the property, including insurance, maintenance, and real estate taxes. In particular, it invests in properties that are leased to critical retailers such as grocery stores, home improvement centers, dollar stores, and medicine stores, which are less vulnerable to disruption from e-commerce or a recession. While Agree Realty is a newcomer to monthly dividend payments, it transitioned from a quarterly to a monthly payment schedule in January 2021. The company has a great dividend track record in the long run in general. This real estate investment trust has boosted its dividend at a compound annual rate of 5% over the past decade. As Agree Realty continues to grow its portfolio, this rising trend is expected to be maintained. It aims to acquire up to $1.4 billion in real estate in 2021, which will increase its rental income and dividend-paying capabilities while decreasing its debt. Agree Realty has a robust balance sheet, which will aid in financing the company's continuing growth. Number 6. Gladstone Land. Gladstone Land is also a real estate investment trust, REIT. They specialize in purchasing property and farm-related facilities, which they then lease out to farmers on a triple net basis in order to generate income for themselves. Because healthy foods such as fruits, vegetables, and nuts are less sensitive to price fluctuation than commodities such as corn, wheat, and soy, the program concentrates on farms that cultivate healthy foods such as fruits, vegetables, and nuts. Gladstone Land has a long history of paying dividends. In the past 26 quarters, the REIT has boosted its dividend 23 times, resulting in an increase of more than 50% in the amount paid out. It intends to increase its monthly dividend at a rate that is greater than the rate of inflation for the foreseeable future. The company's expansion is being fueled by constantly increasing rental income from current farms, which is being increased through annual rent escalations, as well as a constant supply of new farm acquisitions. For roughly $80 million in the second quarter of 2021, Gladstone purchased 13 farms as well as more than 20,000 acre-feet of banked water in the area. These investments helped the company grow its agricultural portfolio, while also lowering the risk of drought-related losses on certain of its farms. Number 5. EPR Properties. Another REIT is EPR Properties. It focuses on owning experiential real estate like movie theaters, eat-and-play venues, ski resorts, and gaming facilities. The venue operators signed triple net leases with it to secure these sites. The pandemic of COVID-19 had a major impact on experiential real estate. Many of these facilities were forced to close their doors or operate at a reduced capacity for a period of time. As a result, they were unable to pay their rent, forcing EPR Properties to stop its monthly payout last year. However, with vaccines becoming more readily available, many people are regaining confidence in their ability to enjoy adventures outside the house. As a result, EPR's tenants are catching up on their rent payments. The REIT was able to resume paying a monthly dividend in July 2021 as a result of this. EPR Properties' current yield is attractive, but as the REIT's portfolio grows, it may be able to raise it in the future. In the middle of 2021, it had more than $500 million in cash and an undrawn $1 billion credit facility, allowing it to go shopping for additional experiential real estate. Number 4. Pembina Pipeline. Pembina Pipeline is a pipeline corporation based in Canada. Pipelines, processing units, storage terminals, and export facilities are all run by the company. Other energy firms are generally leased the capacity to use the company's assets under long-term, fixed-rate contracts. Pembina is able to provide consistent cash flow because to these partnerships. Pembina has a strong dividend history, with payouts consistently increasing over time. As it completes additional energy infrastructure expansion projects, it should be able to increase its dividend in the future. To drive future dividend growth, it has a large backlog of secured projects and several more in the development pipeline. Pembina is investing in lower carbon projects in addition to continuing to support the movement of fossil fuels. Along with its wind energy holdings, it's working on a carbon dioxide transportation and sequestration system with another Canadian energy infrastructure firm. It's also looking into hydrogen possibilities. Number 3. Realty Income. Realty Income is the obvious leader when it comes to monthly dividend stocks. It bills itself as the monthly dividend company, and as of late 2021, it had paid 615 straight monthly dividends. Furthermore, since its initial public offering, IPO, in 1994, Realty Income has grown its dividend 112 times, including in each of the last 96 quarters. This REIT has increased its dividend for more than 25 years, making it a dividend aristocrat. Realty Income should be able to provide investors with a monthly income stream that grows consistently in the future. It has agreed to buy rival REIT Verite, NYSE, VER, in 2021, with the deal expected to finalize by the end of the year. The transaction will create a $50 billion REIT behemoth with a 10% increase in cash flow per share. It will also diversify its portfolio, while keeping financial flexibility to continue buying cash-flowing properties. Realty Income was on track to buy $4.5 billion in properties in 2021, excluding Verite. It has the financial capacity to expand because it has one of the greatest balance sheets in the industry. Number 2. SL Green. Another REIT is SL Green, which is the largest office landlord in New York City. While the city's office sector has been affected by the pandemic, SL Green has fared surprisingly well. The company's rental collection rate and leasing activities reflect this. In 2020, it collected 97.9% of the office rent it billed and 94.8% of the total rent. Meanwhile, during the first 6 months of 2021, this REIT secured leases totaling more than 900,000 square feet at lease rates that were only 1.7% lower than expiring lease rates on the same space. This resulted in a 93.6% occupancy rate. This demand indicates that businesses plan to return to their New York operations in the future. Meanwhile, institutional investors continue to be attracted to office buildings because they provide dependable income. As a result, SL Green was able to sell a number of houses at acceptable prices. It utilized the money to pay down debt, repurchase stock, and invest in new projects. This REIT has also been able to maintain its dividend growth. It became a dividend achiever last year after achieving its 10th consecutive dividend rise. Number 1. Stag Industrial. Another REIT that pays a monthly dividend is Stag Industrial. It specializes on warehouses and light industrial facilities, as well as industrial real estate. These features are in great demand these days, as the pandemic has hastened the use of e-commerce and expanded production in the United States in order to address supply chain difficulties. Over the years, Stag has continuously grown its dividend. Its capacity to constantly increase its repertoire has fueled its growth. Since its IPO a decade ago, Stag has added more than 400 buildings to its portfolio. The company expects its steady expansion to continue this year, with property purchases ranging from $1 billion to $1.2 billion. When you combine that with rising rental income from current properties, Stag should be able to keep raising its monthly dividend. Invest in monthly dividend stocks for recurring income. Investors can easily create passive income by purchasing monthly dividend stocks. They can put that money towards their monthly expenses or reinvest their dividends to generate even more regular cash flow should they need it in the future. While there are dozens of firms that pay monthly dividends, this group of dividend stocks stands out as the best choice for investors looking for a steady stream of income that is likely to expand in the future. What do you think of our video? Let me know in the comments section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.